All right, thanks everyone for joining us today. We are kicking off our first due diligence workshop. Today, we're going to talk about deal sourcing. So as you hopefully recall from last week, the goal of this competition is to really replicate as much as is possible of what it's like being a venture capitalist. And to be a great venture capitalist, you need to basically be able to do three things. You need to be able to source deals, you need to be able to pick the winners, and you have to be able to raise money from others to be a professional venture capitalist. We're not going to cover that last one, but instead we're going to focus in this competition on the first two, which is finding a deal and doing your due diligence and making a good investment decision. So today we're going to cover deal sourcing, just as a basic agenda, we're going to talk about two different types of deal sourcing. One's called thematic and the other is opportunistic. And then we'll talk about some of the deadlines and deliverables. And then we will have a bunch of rooms that we set up with UGF associates in them to answer any questions and work with you and your teams as you're progressing through the competition, just in case you wanted to ask questions, get feedback, support, et cetera, et cetera. All right, so thematic or opportunistic. In venture capital, when it comes to deal sourcing, in venture capital, there's two basic concepts. Thematic or opportunistic. Another way to kind of describe them is, are you a hunter or are you a farmer? And the reality is that everybody is everybody that sources deals as a venture capitalist is probably doing some thematic deal sourcing and some opportunistic deal sourcing. But generally, you'll have people that really focus in on one thing or the other. Now, if you think about it from the hunter-farmer analogy, thematic deal sourcing is like being a hunter. You're going to go out, you're going to identify a theme that you believe, you envision what the world is going to look like in the future. You take a piece of that future worldview and you create a theme that you think will be really important going forward. So that could be I believe that virtual reality is going to be part of the future. We're all going to wear virtual reality headsets. And we're all going to be plugged into the metaverse, and it's going to be like Ready Player One, right? Maybe that's your thesis and your theme. And then what you do is you build a strategy to identify the best companies, and you zero in and you target those companies and you go after them. That's thematic. Opportunistic is the other side of it, in which case you're a farmer and you're going out and you're building relationships, you're planting seeds, you're helping people, you're doing all these things. And then over time, deals come to you. You spend a lot of time kind of cultivating your network and relationships. And then over time, you leverage those relationships to identify the very best opportunities, regardless of what theme they are, and bring them to you. So let's move to the next slide. All right, so let's first talk a little bit more about thematic. And we're going to probably spend more time on thematic than opportunistic, largely because I think thematic is the most effective way to succeed at this competition. Not that there's anything against opportunistic approaches. Some of the best venture capitalists in the world have a very, very strong farming approach to their deal sourcing. But you don't have a lot of time to cultivate relationships in this competition. So in order to be successful, you're probably best off taking a more thematic approach. Now, how many of you, hopefully many of you have heard of the fund Sequoia. Sequoia Capital is arguably the best venture capital fund in the world, largely because they've just had very, very consistent home run wins over a very, very long time, dating all the way back to probably late 70s, I believe. up to the present day. You click the next. So here's just a sum of the companies that they invested in. This is by no means exhaustive, but as you can see, you probably recognize most, if not all, of those brands. Even companies like Yahoo, where you're like, Yahoo, really? Like, that's kind of a lame company today. Still was a massive home run way back in the 90s, during the dot-com boom. So what's interesting about Sequoia is that they have an incredible brand and an incredible track record of investing in great companies. They know how to identify great companies, right? And so you would assume that based on their track record, their brand, their network, deal flow would come to them, right? The door would swing inward when it comes to deals. And while that is certainly the case, that a lot of deals come to them, they've made it pretty clear through a number of different publications and so forth, that they do not credit an opportunistic approach with their success. They credit a thematic approach. And indeed, what they do is what I said earlier. They identify a theme of something that they think will be relevant in the future. And then they go and they identify what they believe to be the very best company in that theme. So if it's virtual reality, maybe what they think is like, hey, there are going to be all of these apps out there for virtual reality. People are going to need a way to know, well, app developers are going to need tools in order to make their apps succeed. So we are going to invest in companies that make tools specially built for VR, right? And maybe that's things like, hey, we're going to build an analytics platform that can plug into the game or into the app that tracks like eye movement and some of these, other kind of little more esoteric things that your typical analytics engine wouldn't track, right? That could be a theme, and that could be the type of company they go after. And then they would go and they would look and talk to every single company that was doing something like that and see if they could find the team that they believed would be able to successfully pull it off. So that's a little bit about Sequoia's approach. You go to the next slide. So what does this mean for you? Well, one of the ways that I think can be a really effective method of using a thematic approach is one to sit back and think about, like, what is the future going to look like, right? Now, there's going to be a zillion things in the future. And so it might help to like really hone in on an area where you have interest or some level of expertise. There are these things called Lumascapes. If you have access to PitchBook, PitchBook will pull together things like this. And they are essentially the value chain of the industry and all of the companies that sit within this value chain. So if you look at this Lumascape, this is the Lumascape for basically ad agencies. And they have the different types. So you have creative agencies, you have digital agencies, you have media agencies, you have marketing and data services, and you have public relations, right? And there are a whole bunch of companies within each of those various categories. So this could be one way to say is like, hey, I think there's an opportunity around investing in digital agencies because I believe over time, like these companies will get bigger and bigger as more and more people spend more of their time, energy, money, et cetera, on the internet, for example. And so you could sit down, you could map out all of the different verticals, how they fit, and then all the different companies, and then identify which companies you think are the most interesting and reach out to them and approach them. You can go to the next slide. Here's another one. Clearly, this has a lot more companies. So this is marketing technology, MarTech, the landscape for it. And this is another like really good kind of like value chain approach. So on one side, you've got advertising and promotion. So all the companies that help with that. You've got content experience. You've got social and relationships. And then if you like zoom in on these, each one has different things. So like under content experience, you could have an email marketing service. And as you can see, there are a ton of different logos that do email marketing. And you might look and say, hey, I believe that email marketing is going to be, you know, the next big thing. Probably not the case, right? Let's see. You know what actually would be a little more interesting is if you believe that like video marketing as it relates to things like TikTok, so short form video content, right? Maybe you believe like, hey, we've definitely proven that like short form video can be done and done effectively through platforms like TikTok and Instagram's Reels. We think that the next big evolution in marketing is to really take advantage of this short form video content. And so we want to invest in a company that does video marketing that's specifically tied into short form video. Or maybe what you say is, you know, their short form video poses a bunch of problems that aren't addressed today with current video marketing tools and technologies. And so we're going to go and look at companies that provide tools that make it easier for marketers that are doing video marketing to do their job more effectively. So maybe that's analytics, maybe that's tools used to actually build marketing campaigns. It could be kind of a wide range of things, right? So I'll give you an example. The metrics of what matters if you're watching a TikTok are very different than the metrics that matter if you are watching a YouTube video, right? Versus looking at a picture versus looking at a social media ad. And so there might be a space for a company to come out with a really innovative suite of products that help companies generate those types of insights better, right? So there could be a lot of different things. As you can see, you know, these are pretty broad. One of the things that I recommend is that if there's an industry or sector that you think is really interesting, to sit down and map out this concept of a value chain. Now, a value chain is basically each step at which value is added to the process. So if you think about like my notebook here, right? This notebook started out as really like a seed and land, right? And so there's a company that went out, bought a bunch of land, they planted a bunch of seeds, they cultivated those seeds, they turned into trees. Those trees were then harvested, they were turned into paper pulp. That paper pulp was turned into paper in big reams, then it was cut up, then it was printed on, then it was bound, then it was shipped off to a retailer, and then that retailer sold it to you, and then you bought it, and then you realized it wasn't exactly what you wanted, and you brought it back and got your money back for it and picked out a different one. That is the whole value chain that occurs, right? And if you notice, I included both the return too, because that's also part of it, right? You got to be able to capture returns and guarantees and so on and so forth, like the risk side of the consumer using it and not being happy. But all along those chain, there are lots of businesses that fit. Right? There's a separate company that grows the trees. There's a separate company that harvests them. There's another set of companies that will turn it into paper pulp, the wood into paper pulp. There's another set that will, you know, cut it up and put it into books, another, you know, et cetera, et cetera, et cetera. So what I recommend is spending some time thinking about industries that you're really excited about and trying to map out that value chain, right? Like where are all the pieces, and identify along that value chain which companies you think will be able to essentially establish themselves as the strongest monopoly and generate the highest number of profits. Because if we think about like the paper industry, for example, it's not really hard to buy land and plant trees, right? It's not particularly hard to chop down trees. It's not particularly It is quite a bit harder to take those trees and turn them into paper pulp. It gets a little more difficult to take that paper pulp, chop it up, put it into books, right? It's probably a little less difficult to take those books and, you know, take them as a wholesaler and push them into retailer. And then retailers, it probably is fairly challenging to differentiate like your notebooks versus other notebooks in the eyes of the consumer. So as things get more difficult to do, right, that usually is a representation of, hey, because it's hard, there's something interesting here, right? And if you can innovate and you either make it easier or you make it more cost effective, or you provide a better experience, right? You can start capturing some of that market share in those areas. All right, let's go to the next slide. Okay, so how do you find some exciting things? One, what's your own experience and where are the gaps? So when we invested in our prior fund, University Venture Fund, we invested in a company called Instructure. They make Canvas, which I know some of you use at your universities. It's a learning management system. So it, got all of your coursework and your grades and communication with your professor, et cetera, et cetera. And one of the founders of that company is this gentleman, Josh Coates. And the way this company got started is he was teaching this class that was like business fundamentals for computer science students. And at the end of the course, he asked, sorry, he didn't ask, he gave the assignment to his students to come up with a piece of software that they think would be an interesting piece of software to build to start a company. And one of his recommendations was, go identify software that people have to use. It's like mission critical, they have to use it, they're forced to use it, whatever, and they hate it. He's like, that's usually a good place to start. And so that's what I mean by gaps. Gaps could be things like products people have to use but hate. It could be also like products people wish they could use, but for whatever reason don't have access to them. Usually a gap, if they're between like what people want and what people can get, that represents a market inefficiency. Or if people are forced to use a software, right, but they hate it, that's another market inefficiency. You're looking for those types of things. And your own experience is probably going to be the most helpful, because if you've experienced it or you've seen firsthand other people experience it, you'll have a pretty good gauge for how strong that pain point is. Another question that I like to ask is, once I start narrowing it down into different sectors and I need to figure out that subsector, is really spending time like rationally thinking through, like, what does the future really look like? Are we really going to be flying around in flying cars? Maybe, maybe not. But if you take like a very rational approach to thinking through what the future might look like, oftentimes you can find like interesting ideas. I also really recommend reading some of the following blogs. So A16Z, which is Andreessen Horowitz's website, if you go to their website as a venture capital fund, it's all content, right? It's their podcast and their blog and their tweets and, just all this content. And what I like about A16Z is they spend a lot of time thinking about what does the future look like. And they interview different people and they talk about software and hardware and fintech and all kinds of things. And then they'll list off different companies that they think are interesting within those spaces. And so they can be a really valuable resource of tapping into how Andreessen thinks about the future, and at least like which sectors are going to be influential in the future. So that can be a good place to start. Another blog that I really like is one called Stratechery. It's this like, strategy focused, technology and strategy focused blog where they talk about technology and strategy and how different strategies are being deployed by different companies, so on and so forth. And oftentimes they're also talking about like, what does the future look like? Tribe Capital is another company that will oftentimes post big, long essays about kind of their viewpoints on the future. And then the last one is avc.com. AVC is the blog, the blog for Fred Wilson, who's a venture capitalist at Union Square Ventures, which is another phenomenal venture fund. And he provides a lot of his insights into, markets, where things are going, and how Union Square is thinking about the future and where they want to invest. All right. So that's kind of the thematic approach. Just to recap, spend some time, thinking about like where pain points are, thinking about like where the opportunities reside. Maybe you think like, oh, enterprise software is a really interesting business model, but there's all these industries that are still using paper and pencil, and we think those industries will eventually be using software. So that's how we define the future. And then kind of really focusing in on the sectors, one or two sectors, right, that are really old and stodgy, right? And then you can basically map out all the different companies that are there, do some diligence, figure out which one you think is the most interesting or the few that are most interesting, and then reach out and say, hey, I'm a student and we're doing this project for this case competition. I thought your company was super interesting. I would love to highlight it as, the company that we pitched to the investment committee at the end of this, which is comprised of a bunch of venture capitalists. Would you be willing to chat, right? That is how, a lot of conversations and relationships get started. All right, so let's shift gears a little bit. Let's just talk a little bit about an opportunistic approach. For the sake of the competition, I think the best way to deploy an opportunistic approach is to look at some of the equity crowdfunding sites. So if you decide you don't want to do the more thematic approach, but you don't have a network, don't worry. That's why we allow you to find companies that are raising on platforms like WeFunder, Republic, Start Engine, and more. They can kind of be like a built-in network for you. So in this case, you're looking for great deals rather than looking for the best deal in a specific industry. Like I said earlier, it's very network driven. It's like who you know, and they bring you deals, right? I'll give you an example of how I do use an opportunistic approach. I have a bunch of friends at different venture funds. I've cultivated those relationships over the last decade and a half. And we periodically hop on a phone call and trade deals. I talk about some of the deals I'm looking at. They talk about some of the deals that they're looking at that are a fit for us. And then we make intros for each other. And it's been an incredibly effective way to find some really interesting deals that I otherwise wouldn't have known about. And as a co-investment firm, that works really well for our strategy. So that's, a good example of how some VCs like myself will use kind of an opportunistic approach. Even though we're talking about opportunistic, I'll give you an example of how I've done thematic deal sourcing as well. So I've always been a huge fan of Internet of Things. And one day, a couple of years ago, I was at Home Depot and came across this product made by Wise, their Wise Cam, which was I think it was a $20 smart camera. And at the time it like blew my mind because I really wanted to install a bunch of smart cameras in my house, but I was dissuaded by like the really high entry point of like $200 per camera. And so I just never did it, but I really kind of wanted to. And then I was at Costco and I saw this camera for like $20 and I was like, no way, this thing really works. But even if it doesn't, it's only $20. So like, I'll try it. So I bought it right there, tried it out, worked great. And then I was like, I love this company, I want to invest. So then I went through my network, found the C-suite, the management team of the company, looked through my network, found somebody that knew them, I did a bunch of additional diligence so that I could come to the meeting prepared and got an intro, talked to them about the company and what they were doing, convinced them to let Little Old University Growth Fund invest, which they agreed to, and then we ended up putting money in. And that company has just been on an absolute tear, growing super fast. So there you go, is kind of a little bit more of like that hunting mentality, right? I knew that like IoT, I think IoT is only going to continue to grow and become a more and more important part of our lives, that essentially software is going to increasingly mix with hardware. and we'll have like really interesting innovations throughout our lives in our physical environment. And then I was like, I think cameras are a good entry point because a lot of people are buying them and using them, and identified Wise as a winner. All right. So going back to opportunistic approach, sorry for that little kind of tangent, but hopefully it was helpful. When you use an opportunistic approach, you still need to refine it a little bit because you don't want to be comparing apples and oranges. And so it can be a lot of funds that focus on an opportunistic approach will still have a fairly well-defined investment strategy. And that's helpful for a number of reasons. One, it helps them become kind of experts in their field. And two, people know that that's the type of company that they look for, and they send them those types of deals. So if you're going to use an opportunistic approach, I'd recommend at a minimum saying, you know what we're going to look for is enterprise SaaS companies, enterprise software companies, or we're going to look for consumer products companies in the like beauty and the beauty product space or the food space or whatever it might be. Or we're going to look at fintech companies and then go onto these platforms like WeFunder, Republic, Star Engine, and basically sort through. They have filters and just say, okay, show me all of the software businesses, or show me all of the food, consumer products, food businesses, or what have you. And really focus in on that. And that way you can kind of really quickly identify which ones are the most interesting without kind of, oh, well, I have this one software deal and I've got this consumer products deal, but they're kind of apples and oranges and harder to compare one against the other. All right. So regardless of which approach you're taking, whether it's a thematic approach or an opportunistic approach, here are some things that I would start looking for in potential deals, because you're going to hopefully see a lot of companies and you'll need to very quickly say yes, no, yes, no, yes, no, interesting or not, so that you don't waste all of your time going down rabbit holes on deals that you don't want, that ultimately don't make sense. So here are the like three of the big. Could you skip one slide and go back, Rocky? All right. No, sorry, go forward, forward. Okay, go back. Okay, sorry. Just wanted to make sure I had the right slide deck. Okay, so these are the first top three things that I would look for when evaluating a deal. And then I've got a long list of kind of like tier 2 questions that I would ask myself. So the first one is, do they have a unique product or business model? Do they have some sort of competitive advantage? I'll give you an example. There was a company that I met with that raised money on WeFunder, a company called Beatbox. Beatbox sold wine in it was like a wine cooler in a box. Kind of a little bit different, right? But that company was doing incredibly well. And part of the reason for that was they had this really great branding that really kind of spoke to the eco-friendly nature of their product, because it came in these like recyclable boxes, and they had lots of like super trendy marketing, kind of in-your-face stuff. And because of that, they had built this like really interesting brand that was allowing them to grow really fast and build a very loyal customer base. Now, in that case, they don't have some of the more standard competitive advantages, but they had a really strong brand and story, right? And so it was kind of unique, and nobody else was doing kind of wine in a box in the same way. So do they have something unique? The next one is it a big market, right? Now, the reason you want to look at big markets is because if a market is really big, right, hopefully then that company has the potential to get really big. But it's also important because oftentimes companies will pivot, right? They'll change what they're doing. And so you want to be in a market that's big enough that if you have to pivot your business, change things a little bit, you are still sitting in a really, really, really big market. A good example of this is companies like Airbnb. When Airbnb first launched, it wasn't so much focused on renting out an entire home. It was a lot more focused on renting a couch or a bedroom within a house, right? And over time, while they still offer those products, the bulk of what they do is rent to the full home. So what was important is that they sat within this huge market, which is like more like hospitality, generally speaking, right? And because they sat within this big market, it didn't matter if they pivoted from like couches to bedrooms to whole houses, because the overall market was so big. So you want to look for like really, really big markets. And then the last thing I'd look for is look for the killer team. So do they have a ton of experience? Do they have passion for what they're doing? Do they have what we call team market fit? So team market fit, the idea there is that you have the right team for the market and the product and the solution that you're trying to sell. So for example, it wouldn't make sense for somebody that is super old and has a ton of experience working in technology to go out and start the next latest, greatest social media company, right? Just as it probably wouldn't make a ton of sense for a student to drop out of college and start the next great big enterprise software company that will go head to head with Salesforce, right? So you want to think about, like, is this team have the right experience and also the right mindset and the right insights and so forth for this particular market? And then lastly, and this is highly tied into team market fit, is this concept of called an earned secret. So a lot of VCs will talk about this concept of an earned secret. And at the end of the day, what it means is you look for management teams, for founders that have really, they've identified a secret that nobody else knows. And most people don't think is true, but they've done the hard work to validate it as being true. So going back to Airbnb, I'll give you a great example of an earned secret. So the way Airbnb started is that the founder was struggling to make rent, which is kind of ironic because now he's one of the wealthiest people in the world. But he was struggling to make rent, and he noticed that there was a really big tech conference coming up, and that all the hotels were selling out, and it was really hard for people flying in for this conference to find a place to stay. And so what he did is he went on to Craigslist and he started advertising air mattresses in his apartment, right? It's a crazy idea, right? Like, pay, $30 a night or whatever, and I will give you an air mattress on the floor of my apartment. But what's even more crazy is he had a lot of people book his house, his air mattresses. And what was really interesting about this is he then took this and he went to a bunch of venture capitalists, right? And he pitched this idea to these VCs, and the VCs were like, are you crazy? Like, the liability issues, like, what if somebody dies? Like, do you think people are going to trust a total stranger in their house, or trust themselves in another total stranger's house, right? So many venture capitalists passed on Airbnb and missed out on generating just insane returns for their fund. But that's because those venture capitalists hadn't earned that secret. And so you want to look for those founders that have earned the secret and then can communicate it effectively. Now, there were some VCs that did have that insight, that the founders of Airbnb had found this secret, they had earned it. And even though the majority of people would say it's absolutely crazy and bonkers for, to go stay in a total stranger's home for a night, they knew that people would do it and that they would pay to do it, right? And that it would work. And so that's, one of the things you can look for as well is, like, has this management team earned some insight that allows them to kind of solve a pain point in a unique way, or identify a market that's overlooked, or whatever it might be. So, all right, let's go on. So what I'll do is, like, I'll start like skimming. I'll narrow it in on the things I want to focus on, sector wise. So maybe it's like, I want to look at enterprise software, and then I'll start going through companies and I'll look for these three things. Unique product or business model, some sort of competitive advantage. Are they operating in a huge market? Do they have a killer team? Once I've identified the ones that I'm most excited about, then I'll go to the next level, which is the next slide. And I'll look for a bunch of these criteria to really hone in on the ones that I'm most excited about. So the first one is, can it scale super fast? You don't have a lot of time to scale these things. I'll give you an example. So I've got software here as an example. That's kind of an obvious one, right? Like once I built the software, I can sell it to a zillion people, or I can sell it to one, and it's, the cost of selling it to one versus a zillion people isn't that big of a difference because I just made the software once and then I can distribute it, right? But like, let's talk about food. So you might say food is not super scalable, can't grow super fast because every time I sell, let's say a cookie, I got to make that cookie and then I got to sell it to somebody. But there are different business models that could be used to allow a company to grow super fast. For example, what if you set up a cookie company that didn't have any retail locations, right? So for those of you that are familiar with like Crumb, or some of the, the various cookie companies in Utah. What if instead of having a retail store, you go to all of these what are called dark kitchens, where it's a kitchen that makes food, but it's not open to the public. It only works through DoorDash and Uber Eats and so forth. What if you made a cookie company that you could only buy the cookies through DoorDash, right? And then all you have to do is ship cookie dough to hundreds of dark kitchens all over the country. Those dark kitchens could make the cookies, couriers could come grab them, take them, deliver them. It would actually be like a relatively fast and easy way to scale a cookie business, right? So that it doesn't necessarily matter what the business is in. Think about like if that company can scale super fast or not. Another thing is, does it have unique access or partners that really set it apart? So if it's just a general cookie company and they don't really have anything like interesting or special or some unique access or partnerships, like, there's a lot of cookie companies out there that are competing for it. So if you don't have something unique, maybe not the right fit for you. Does it operate in a huge potential market? Now, I put potential here because sometimes you'll look at the market and you'll say, the market today for people sleeping on other people's couches is like non-existent. But there's this huge potential market in that if they can somehow crack that, there are a lot of people that would like to travel and they can't afford to travel. And one second, I just need to plug in my phone. No, that did not do it. Give me 1 second. Okay. So huge potential markets, right? Like I said, with Airbnb, the number of people that may be willing to pay to sleep on somebody else's couch may be small today, but if Airbnb can figure that out, then they can tap into the overall hospitality market. But even more than that, like competing with hotels, they could and this is really what they've done, is they can bring travel to more people that before couldn't afford it, right? Think about how many people have enough money to sleep on somebody's couch, but don't have enough money to stay at a fancy hotel, right? And if at the time, your only option is stay at a fancy hotel and you can't afford that, then that means you don't get to travel. Whereas if you can lower that price and make it more accessible, that opens up this huge additional potential market. So be thoughtful about like, hey, maybe the market's not super big, but the potential market is really big and very disruptive. has unfair advantages over competitors like network effects and so forth. This is a continuation of like, does this company have something unique? And really it's like digging in deep to see, okay, this is kind of a unique business model relative to a lot of other things I've seen out there. But do they have something that gives them a really truly unfair advantage that's hard for other companies to replicate what they're doing? So maybe that's like, hey, this company has a partnership with, a big retailer, right? And so because they've got this partnership with like Target, right, they're going to be able to get their product into Target, whereas other companies couldn't, for example. That gives that company an unfair advantage over its competitors because of that partnership. All right, the next one is, and the last, sorry, go back. And the last thing that I would just focus on too, and this is kind of a check the box, is can the investment create liquidity in the next 5 to 10 years? And what I mean by that is, if you invest, what's the likelihood that the company is going to be acquired or go public in the next 5 to 10 years? Going public is a really high bar, and that's, pretty hard to achieve, but it is possible if a company can get to about $100 million in revenue. So if you believe this company has the potential to get to $100 million in revenue, there's probably a good story there that it could go public. The flip side is maybe you look at it and you say, I think there's a really interesting way to build like a design platform, right? Where it's a better user experience to design different applications from a user experience perspective, right? Because everybody's kind of tired of using Adobe. It's clunky, it's old, it's not in the cloud, blah, blah, blah. You got to download all these things. So we're going to do like a cloud-based, easy to use, better user experience design tool for designing user experiences for apps, a la Figma, right? Because we believe that Figma, by doing so, we've got a lot of potential acquirers. Adobe could come in and acquire us, and Microsoft could acquire us, so on and so forth. All these companies that are building software to help designers could come in and buy us. And that could be your thesis. It's like, hey, we're going to build something that has lots of potential acquirers that we could sell to. So make sure, though, that either way, no matter what type of company you're investing in, if it's consumer products, enterprise software, or what have you, that has that ability to be acquired or go public. So, for example, you really wouldn't want to invest in like a restaurant that just has one location. Probably not going to ever get acquired. Great lifestyle business potentially, but probably not going to get acquired. Or investing in a gas station or like a convenience store, right? Those don't really make sense as a venture capitalist. But, you could invest in a consumer products company that sells beauty products because you believe that Estee Lauder and L'Oreal and so on and so forth would acquire that business once it reached enough scale. And that's exactly what they do. All right, my laptop works again. All right, so just to recap, look for companies that can grow super fast, right? You've only got 5 to 10 years before you got to exit your investment here. So they got to go from really small to really big in that short time period. Look for companies that have some sort of unique access or unique partners. And when I say unique access, what I mean there is like unique access to their target customer.
Maybe it's through a partnership that they might have, or some really kind of unique branding. There could be, lots of different ways in which a company could have unique access. With my Wise example, the fact that they're selling in Home Depot is kind of unique, right? It's unique access to to customers through Home Depot. Operates in a huge potential market, right? We talked about the difference between current market and potential market. I would say oftentimes some of the biggest companies are ones that are focused on potential markets, where the need is really, really big and isn't being solved. Has unfair advantages over competitors, so like network effects, and then can create liquidity in the next 5 to 10 years, because you need to be able to invest, you need to be able to sell and get out and return that cash, those profits back to your investors. All right, so for this competition, I want you to assume that you have a $50 million fund and that you are in year 1 of a 10-year fund. So most funds are structured to last about 10 years. You make your investments in the first 3 to 5 years, but usually kind of more like 3 years. And then over the next 7 years, for a total of 10 years, you're then supporting those companies and hopefully harvesting your investments over time, where those companies get acquired or go public and generate profits, and then those profits are returned to your investors. As a seed fund, you should probably be targeting somewhere between 30 and 50 seed or early stage deals in your fund. So the idea being that you're going to invest somewhere between probably $1 to $1.5 million into each company. What does that mean? That means that if you want, each deal to have the potential to return your whole fund, then each deal has to have the potential of returning 30 to 50 times, right? So huge outcomes. But look, it doesn't necessarily have to be the case. You don't need to target 30 to 50 seed deals if you don't want. There are different schools of thought here. So I'll give you an example. There's an investor, Ron Conway. He's like considered the godfather of Silicon Valley by many. He backed a number of just amazing companies like Facebook and Google and Pinterest at the he was like first money into those companies. And what's interesting is he kind of pioneered this whole concept of being an angel investor. He went out and he raised money from a bunch of individuals, and then he went to work investing that money into seed stage deals. He made 50-ish investments out of his first fund. He lost money on all 49, but the 50th company was a little company named Google that returned all of the money that he had lost on all of his other investments by an order of magnitude, like 2 or 3x. Actually, I think it was more than that. It was like 3 to 5x his total fund amount. And by doing so, he really proved out that you can make money as an angel investor investing other people's money. Not really an angel investor, but really like a seed stage investor. So that's one school of thought is, hey, I'm going to sprinkle a lot of seeds out there and hopefully one of them grows into a sequoia, right? But if not, not if not. Knowing full well that like a lot of them are probably just going to straight go out of business. There's another approach. So you could approach it like Mucker Capital out of California, Southern California, and they make only a handful of bets. Very concentrated. They write bigger checks into each one of those companies. They're very engaged with the companies in terms of helping them. And they also have done incredibly well with that approach. So figure out whatever your approach is, but be able to like really walk through logically like the rationale for how you're approaching the deals. So you should be thinking like, how much are you going to invest in the company? What are your ownership targets? And how much money are you going to hold in reserve? Because oftentimes what happens is you invest and then the company comes back to you and they're like, hey, I need more money. And if you don't invest, you could lose the majority of your current position as other investors come in and help the company. And so you want to be able to have that money to protect your original investment and put more in. The other part of that is you want to invest in your winners. And so if you invest in a company and they start taking off and going to the moon, you want to put every single dollar you possibly can into that company, because it's so rare for companies to take off and do really well that when they do, they tend to hit it really, really big. And so even if the valuation goes up and you're not able to buy as much of the company for each dollar you invest, if it's truly your winner, it's likely that as that company outperforms, you'll still generate a better return on that investment than some of your others. Rocky and I were talking to this investor a few months ago, and they're in some of the best fintech deals out there. And we talked about how, he was super blunt. It was super, super interesting because he was really blunt. He was like, we invested in these two companies that were just absolute home runs. And he's like, and rather than put more money into them, we took the rest of our money and we put it into all of our other portfolio companies that were all horrible companies, and basically lost all the money we put in. Or maybe we got, it back, but we just got it back. We didn't get a return. He's like, what we should have done is we should have said to all of those other companies, hey, you know what? Life is short. We're going to shut this puppy down and you're going to go start your next big, great thing. We're not going to put any more money into you. We're going to put all of our money into our winners. He's like, if we had done that, our fund would have generated another like multiple on the fund or two. So that's the idea behind reserves. And then you want to think about ownership targets, right? So that really comes down to valuation. If you're going to invest in 50 seed deals, then you probably better get into these deals at really low valuations. If, on the other hand, you're going to invest more concentrated, maybe you can afford to have higher valuations, but you're also going to write a bigger check. So you're going to end up owning, hopefully, a larger percentage of the company. At the end of the day, the math on this is really simple. You basically just say, okay, if I'm going to invest $1 million at a $9 million pre-money valuation and a $10 million post-money, then I will own 10% of the company, right? I put in $1 million into the company. And then if they're valued at $9 million and they take that additional million, they're now worth $10 million, because hopefully they didn't destroy that $1 million of value that you just gave them immediately. And so now you own 10%. And then if that company, eventually becomes a $1 billion company and you sell, your 10% ownership in an IPO or through an acquisition, you now have $100 million, right? So those are the kind of targets that you should be working with, is to help you identify how much ownership you need to get in the companies you're investing in. All right. So I shared this list before. This is the same or similar list of a bunch of equity crowdfunding sites. The one that's, they're all here. Okay. The ones that I would probably focus on are Start Engine, WeFunder, and Republic. They're the three largest players in the space. With the exception of AngelList, if you can get access to AngelList, that can also be a super valuable resource. The nice thing with Start Engine, WeFunder, and Republic, and some of these other equity crowdfunding sites, is that they have quite a bit of information that they disclose publicly about the company. And the reality is, because you could invest personally into these companies, it checks that box of being able to say, yep, this is a company where I have the data about it and I could invest. If you don't want to go that route and there's a company you're super excited about and you reach out to them and they're willing to work with you, then you need to get some information, something about their traction. So it could be like high level financial numbers, users, and then like details about their business model and how they make money. So you can actually dig in and do your due diligence. And look, the reality is it's going to be hard to get them to share information like that because they're going to be hesitant to share confidential details about their company. But if you can convince them to do it, in my mind, it's kind of like the same as if you were able to convince them to let you invest in their company. Because investing, especially venture capital, is a little bit like dating. Whoever is kind of the most attractive or wants it the most tends to have more power in the relationship. And so it's the same in venture investing. If a company is super hot and by that I mean they've got a killer management team, they've got this amazing product that customers just love, they're growing really fast, they've got huge barriers that make it hard for others to invest or compete. And all the VC and like the entrepreneurs of like are known entities that have been there, done that, built companies, sold companies. Every VC is going to try and get in on that deal, right? And it can be really hard and competitive to get in. On the flip side, if like it's a first-time founder and they're still figuring things out, right? And maybe they don't have a super strong competitive advantage and not as much traction, the deal is just less attractive, right? And so in that case, the venture capitalists have more power in the relationship. You want to be in the deals that are the most competitive at the end of the day. And so that's what I mean by you have to be able to earn your way into that deal. You have to be able to convince the entrepreneur to take your money versus somebody else's. And that is a real challenge in venture investing, because there are a lot of funds that have money that are competing for access to those deals. If you remember, like what we talked about last week, venture capital is all about power law. There are only a handful of deals every year that really, really matter, right? There's only one Airbnb that was founded that year, right? That ended up generating a huge, massive home run return. And if you weren't in that deal, you missed out, right? So some of the hottest deals are some of the hardest to get into. And so to replicate that to some degree, we want you to be able to get some of this information from them and pitch it. We don't promise confidentiality, but the flip side is we're not going to be out there publishing it for all to see either. So they just have to be comfortable with students seeing it, and then venture capitalists who are on the judging panel seeing it.
Hey, Peter, what if the companies are pre-revenue? Do they still need financials?
That's a great question. So they don't necessarily have to have financials, but they have to have something else to demonstrate like traction, users, partnerships, something that says, hey, this has got, so you have to have like some details where you can actually like dig in and do some due diligence, if that makes sense. All right. So just some dates to remember for the competition. October 21st, so coming up real quick. We need you to submit your selection of and description of 3 companies. Now, you don't actually even have to choose one of these companies as the ultimate company that you're going to do your due diligence on and pitch. But we highly recommend that it's one of the 3, and it's that you have 3 that you're most excited about. Because oftentimes what happens is teams will identify the company that they're most excited about. They don't think about like any others. They start digging in, they identify that. Then they find out like the CEO was like convicted of fraud, and it's a total deal killer, but it's too late for them because they've already kind of made the decision to move forward with that investment. And so, like they got to start all over from scratch, right? But if you got 2 more companies kind of in the wings that you've identified, then you can say, well, okay, we did lose some time here, but at least we've got 2 more that we can dig into. We don't have to start all over. Next week, we're going to talk about more due diligence. Next week, we're going to kick off due diligence training. where we're going to dive into some of the basics around business models, how to evaluate business models and management teams and so forth. And then on the 26th, we'll finish out the rest of the due diligence where we talk about like financials and returns and market, or I think market we cover on the 19th. And I think we cover competition on the 26th. When that's all done on November 4th, you'll take all of your due diligence that you've been working on and you'll submit your presentation. We'll review those. We'll announce the top 5 teams on the 8th, and then pair those top 5 teams with mentors from different venture funds to give you feedback and coaching and really help you prepare for the final presentation. Those final presentations are due on the 15th, and then we'll have regional semifinals and then our national final competition December 1st. We're hoping to do the regionals in person, so stay tuned for date and location for that. And then nationals will be virtual. Mm-hmm. Anything I missed there that you want to add, Rocky?
Nope, I think that's everything. If you still have not sort of registered a team, tonight is the final night to do that. You can just go to the website. Even if you don't have a team yet, please just fill it out anyways. And then we will get you matched up. I'll send out the final team assignments tomorrow morning after I get everyone's submissions, which are due tonight at midnight. Yeah, I think that's everything.
Awesome. Any questions before we kind of wrap up the training?
Yes, Peter.
Yeah.
Yeah. Regarding the team registration, I'm not yet in the team, but I think I tried to fill out the form, and I received it twice. I fill it out twice. So I'm even worrying about, I mean, did I count that does it count that form that I have already filled?
If you have filled it out and submitted it, then you should be in the system.
Okay.
Hey, Fabian, are you in Utah or San Diego?
Utah, University of Utah.
Okay. Well, I'll look it up right now and let you know via a private message.
Thank you.
Hello, can you kindly just check if I am registered in a team, because I have a friend of mine with a different university, but I would like to join their team if it's possible. Is it?
Yeah, totally possible to join from different schools.
Yes, but I don't know the process, so how can I make sure that I will register today?
Probably the easiest way is to submit a team submission with all of them plus you. And then we'll just, we'll double check duplicates and make sure that the one that has you on it is the team that's registered.
Okay, so I counted my friend Abdurrahman, okay?
Sorry,
Hey,
what?
are you in San Diego or Utah?
I'm at BYU.
Okay. So if you go to the website, I just posted that in the all chat, and then click on the Utah link. There will be a big link that says team registration. If you click on that and just put your name in and your teammate's name in, you'll be registered in our system.
Okay, thank you.
Sure.
Yeah, I'm sorry. I have a question. So we already submit a form for our team, but we're looking to add a new member. So is the process just resubmit a new form, or do we have to email you guys and let you know?
Yeah, just submit a new form. That's probably the easiest, right, Rocky?
Okay. Yeah, that's easiest.
Awesome, thank you.
All right. Well, does anybody want any personalized feedback or help? If so, we can set up a chat room, a couple breakout rooms, and Rocky and I can hop in those and meet with teams. If not, no worries. We can wrap it up and call it a night.